In Part G, discuss the limitations of the method used by the candy division to set selling prices. And this is for 5 marks. Okay, so we know that the candy division sets their selling prices by taking their total product cost. They then add a 20% markup, and that gives them the selling price. All right, so what are the limitations or disadvantages of determining or setting selling prices in this way? The first thing to note, guys, is assume this is your company. Assume this is your company and you sell Brighties and Giggles, and you work out what it costs you to make the Brighties and Giggles. You just add a 20% markup, and that's how you determine your selling price. What's the problem with that? You're not considering the external environment at all. Remember, this company doesn't exist in a bubble. This company exists in an environment where there's competition, etc. So they need to consider what competitors are charging. You can't just charge anything. If there's a competitor that's selling a similar product, what are they charging? Because that will influence your selling price. You need to consider what the demand is for this product, because that will also influence your selling price. You can't just ignore the external environment completely when determining what your selling price for your product should be. Then in addition to that, anything that goes into the total product cost is obviously going to have an impact on the final selling price of the product. So if we go back to the information provided in the scenario, fixed conversion costs are allocated to products on the basis of machine hours. So the division is using traditional costing to allocate fixed conversion costs to products, where they calculate one allocation rate using machine hours. They don't use activity-based costing. They are not accurately looking at which product causes the cost to allocate the cost. Instead, costs are just allocated to products on an arbitrary basis. So if costs are allocated to products on an arbitrary basis, that's going to lead to arbitrary selling prices. There's also the problem that if total product costs increase, selling prices will also increase. So this can lead to a complacent attitude towards cost control, because cost increases are just passed on to the customer through higher selling prices. Now, this is extremely dangerous where luxury products are sold and demand is elastic. So what do I mean by that? The candy division sells candy. They sell Brighties and they sell Giggles. Both of those are luxury products. So if they change the price, or if the price increases even by a small amount, that could have a large impact on demand, and the customers will stop buying the product from the candy division, and instead they'll look for substitute products and they'll go to competitors, etc. So it's very dangerous to just pass those price increases on to the customer when you are selling a luxury product, because it could have a very negative impact on demand. And linked to that, there's another limitation that we can discuss. If demand decreases, then fixed overhead costs are going to be shared between fewer units. So the product cost per unit will increase. And if the product cost per unit increases, selling prices will also increase. And if selling prices increase, that will cause demand to drop again. So this is just a vicious cycle, because as demand keeps dropping, the fixed overhead costs are shared between fewer units, and the total product cost per unit increases, causing the selling price to increase. And then because the selling price has increased, demand decreases. Fixed overhead is shared between fewer units. You can see the problem. This is just a vicious cycle. All right, guys, so those are the limitations that I was looking for in Part G of the required.